In the next few years, you're going to hear the word silver everywhere. Not because it's a cool investment, but because the world might not have enough of it. And I don't mean prices might go up. I mean the kind of shortage where industries start panicking, and regular people suddenly realize they've been sleeping on one of the most important metals on Earth. Because here's the terrifying part. Silver isn't just an investment metal like gold. Silver is a survival metal for modern technology. Solar panels need it, electronics need it, data centers need it. And the next generation of batteries could need so much silver that it competes with the entire world at supply. Which means the biggest silver shock won't happen when the price is cheap. It'll happen when it becomes impossible to buy. And by the time the news starts screaming about it, the biggest move will already be underway. Today, I'm going to break down what's really happening. Why silver is different from any other asset. And the hidden trigger that could send this market into a once-in-a-generation explosion. Don't forget to click on that subscribe button and like this video, as it's the best way to support this channel. Most people hear silver might go to $300, and their brain either lights up with greed or shuts down with disbelief. But the smarter way to understand silver isn't the silver price. It's the relationship between silver and gold. There's a metric for this called the gold to silver ratio, and it's brutally simple. It tells you how many ounces of silver it takes to buy 1 ounce of gold. If the ratio is 80, it means silver is cheap relative to gold. If the ratio is 20, it means silver is expensive relative to gold. This ratio matters because gold and silver are connected not just culturally, but psychologically. They are both monetary metals, and throughout history, societies have constantly compared the two. So when the ratio gets extremely high, it suggests silver is historically undervalued. But here's where things get dangerous. Ratios don't just drift, they can snap. And when they snap, it creates those rare shock moves, the kind of moves that become documentaries later. If gold is $3,000 and the ratio is 100, silver is 30. If gold stays at 3,000 but the ratio collapses to 10, silver becomes 300. Notice what happened there. Silver didn't need gold to rise at all. Silver simply needed its position relative to gold to reset. That's what excites some analysts and terrifies others, because it suggests silver doesn't require a perfect economy or a strong stock market or political stability or any normal supportive condition. Silver just needs the relationship to correct. Now, historically, that relationship has lived in ranges that modern investors would find unbelievable. In some ancient systems, silver traded at ratios like 8 to 1 or 10 to 1. Even in more modern eras, 15 to 1 was common for long stretches. So why has the ratio been 60, 80, 100, even over 120? One word: financialization. And another word: suppression. But let's be careful here, because suppression sounds like conspiracy when it's explained badly. When explained properly, it's just system behavior. When someone says silver is suppressed, most people imagine a secret group in a dark room controlling the price. That's not how markets work. The modern system doesn't need a villain, it only needs incentives. Silver is part of a financial structure where paper contracts can be created in enormous volume. And when paper supply expands far beyond physical supply, the price becomes less about how scarce is the metal and more about how liquid is the market. In other words, silver behaves like a financial instrument more than a physical object, until the physical suddenly matters. This is the key point most people miss. The price of silver is not set in the same way the value of clean water is set. In an emergency, water becomes priceless even if it used to be cheap. And silver has the exact same potential under the right conditions. Because silver is not only a metal you invest in, silver is a metal civilization consumes. Gold, by comparison, is mostly stored. Gold's primary function in the world is to sit somewhere untouched. Gold is hoarded, silver is used up, destroyed, lost in tiny quantities, spread through electronics, embedded in systems, thrown into landfills, dispersed into dust. So over long time frames, gold accumulates, silver disappears, which means the real silver supply is not what people assume. It's not as simple as, we mined it, therefore it exists. It exists only if it's recoverable at a reasonable price, and that's what turns silver into a potential powder keg. The real silver problem: most silver is not mined for silver. This is the part that changes everything. Most people think silver comes from silver mines. It doesn't. A huge portion of global silver production comes as a byproduct. It's extracted while mining other metals: copper, zinc, lead, gold. And that creates a strange supply trap. If silver demand skyrockets, you would think miners would just mine more silver. But if silver isn't the primary target, the supply can't respond the normal way. A copper mine doesn't triple its output because silver is hot. It produces copper based on copper economics. Silver just comes along for the ride. That means even if silver prices explode, supply may not increase fast enough to stop it. That's not normal. Most commodities have a supply response. If oil rises, rigs activate. If wheat rises, fields expand. But silver is handcuffed to other industries. It's chained to the mining cycles of other metals, which means supply isn't simply tight, it's inflexible, and an inflexible supply facing explosive demand leads to only one outcome. Price becomes the rationing mechanism. And that's where we get these impossible price targets, not because someone wants a wild number to go viral, but because the system might be forced into it. Now, let's talk about demand, because this is where silver transforms from a niche investment into a strategic material. Silver is one of the best conductors of electricity on Earth. That's not marketing, that's physics. Silver is essential in electronics, solar panels, medical devices, data centers, high-end military technology, advanced manufacturing, and increasingly, energy storage technologies. And here's the real issue. We are building a world that uses more electricity than ever before, not just more, exponentially more. EVs aren't just cars, they're rolling electrical systems. Solar and wind don't just generate electricity, they require huge networks of storage and distribution. AI infrastructure isn't just software, it's physical energy consumption at scale. We're moving from an oil-centered world to an electricity-centered world. And silver is the bloodstream of that electrical world. So demand for silver isn't rising because of investors. It's rising because of civilization's design decisions. And if even a portion of new battery technology uses large quantities of silver, you don't just have higher demand, you have demand colliding into a fixed wall. Here's why people dismiss silver. They say, it's not that rare, we've always had silver. And that's true in a surface level sense. But the market doesn't price surface level truth. Markets price bottlenecks, markets price panic, markets price urgency. Silver can go from plenty to not enough without warning because it is required in small quantities across many industries. So it doesn't take a complete shutdown to create a crisis. It takes a few industries competing for the same limited pool. Solar manufacturers need it. Electronics need it. Military supply chains need it. Medical and industrial systems need it. And investors, sensing the squeeze, start hoarding. At that point, the entire market flips because consumption demand stays strong, but investment demand becomes a vacuum. And vacuums don't negotiate. This is the exact same pattern that has occurred in other commodities during supply shocks. The market doesn't rise gently. It gaps. It spikes. It becomes discontinuous. That's why when people talk about silver going parabolic, it's not about hype. It's about the nature of thin markets under stress. Silver is a smaller market than gold, and smaller markets move violently when institutional money enters. Even a small reallocation of capital can distort price massively. Now let's talk about the part that almost nobody prepares for, the emotional part. Because even if silver is fundamentally positioned for a major move, the average person will not capture it. Not because they're stupid, because they're human. Here's what happens in most commodity blow-off cycles. Silver rises. People feel smart. It rises more. They start fantasizing. It rises again. They start panicking. Not panic selling, panic thinking. They check the price 10 times a day. They start calculating profits. They start imagining losses. Then silver drops 10% in a few days. They feel like idiots. They swear they'll sell if it recovers. It recovers. They sell, then it doubles. That's not theory, that's behavior. The most painful part about these cycles isn't the volatility. It's the regret. And the regret usually comes from one thing. People focus on price, not structure. If silver runs, it won't do it smoothly. It will overshoot. It will become a story. It will become a headline. It will become a bubble narrative. And that's when the biggest gains are usually being formed. Because parabolic markets have a brutal reality. Most profits happen at the end. That doesn't mean always hold forever. It means you need a plan that accounts for the irrational phase, because irrational phases are where the biggest money is made. But it is also where most people exit. Here's where this whole discussion gets much deeper. Some analysts argue that if silver reaches 4-digit levels, it may not be because silver is worth more. It might be because currency is worth less. That's a different story. That's not a commodity bull market. That's a monetary transformation. And here's the truth. Both scenarios can occur at once. Silver can be repriced because of physical shortage and because money is being diluted. If governments expand money supply over time, assets that can't be printed tend to rise. Gold and silver become monetary mirrors. They reflect what currency is losing. So when someone says, I'm not sure what the dollar even means anymore, what they're really describing is a world where pricing isn't stable. A world where an ounce of silver might buy vastly more real goods than it used to. That's why this isn't just about investment returns. It's about purchasing power. It's about resilience. It's about optionality. And in periods where trust in the system declines, assets with long history tend to reassert themselves. Silver has thousands of years of monetary history. It's not a new invention. It doesn't require belief. It requires only scarcity. Now picture this. What if multiple nations begin competing for silver as a strategic resource, not as an investment, as supply chain security? What if the world enters a deglobalization era where nations stockpile critical materials? We've already seen this dynamic with rare earths, semiconductors, energy, food supplies. If silver becomes viewed as critical infrastructure material, demand changes character. It becomes political demand. And political demand doesn't care about price. Political demand cares about control. This is why people who dismiss precious metals as barbaric relics often miss the point. Metals aren't just relics. They are non-negotiable inputs into the real world. And when modern systems depend on them, they become strategic. So what should a rational person do with this information? Let's bring this back to reality. If you're listening to this, you probably fall into one of three categories. 1, you own no silver and want to understand the thesis. 2, you own silver and want to know if you're crazy. 3, you're already bullish and want to know how not to mess it up psychologically. Here's the most important concept. Don't treat silver like a normal investment. Silver is closer to insurance mixed with speculation because its behavior is asymmetric. It can do nothing for years, then shock upward in months, then crash, then rebuild. So the correct way to approach silver is not emotional, it's strategic. That means, first, understand why you own it. Is it a hedge against currency debasement? Is it a speculation on supply shortages? Is it diversification? Or is it panic buying? Because panic buying is the worst reason. Panic buying creates panic selling. Second, know the risks. Silver is volatile. It can drop 20% fast. If you can't psychologically handle that, you shouldn't size it too large. Third, think in ratios and purchasing power, not just price targets. Instead of, will silver hit 300, think, how will silver behave relative to gold, real estate, stocks, and inflation? That's how professionals think. Finally, plan your exits, not just your entries. Most people obsess about when to buy. Smart people obsess about when to sell and how not to ruin the trade. Because the hardest part of a parabolic market isn't buying, it's holding through the chaos. Let me end with the most important piece of this entire story. If silver truly enters a mania phase, where it goes from being ignored to being chased, it will not feel like a fun opportunity. It will feel like fear. It will feel like instability. It will feel like the world is changing too fast. That's why most people don't win in those phases. They don't have the emotional wiring to stay calm. But if you understand the structure, the supply constraints, the industrial demand, the historical ratio behavior, the nature of monetary cycles, then you don't need to panic. You simply need to think clearly. And whether or not silver reaches 300, 500, or something even higher, one thing is already true today. Silver is not just a metal. It's a pressure point. It sits at the intersection of industry and money, technology and history, supply chains and financial trust. And when something sits at an intersection, it doesn't move linearly. It moves suddenly. So the real warning isn't silver might go up. The warning is this. Most people will only start caring about silver when it becomes impossible to ignore. And by then, the easy part is gone. The quiet accumulation phase ends. The volatility phase begins. And history tends to reward people who prepared before the crowd showed up. Not because they predicted the future perfectly, but because they understood the structure early enough to stay rational when everyone else became emotional. That's the real silver story. Not hype, not charts, not promises. Structure, scarcity, and human psychology. And whether silver becomes the greatest wealth transfer in precious metals history or simply a powerful repricing cycle, the lesson remains. The world is running out of things that can't be printed, and silver is one of them.